We have just had a massive paradigm shift in the real estate market that could dramatically impact home prices going into 2024. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over interest rate super cycles. We've all heard about commodity super cycles, but interest rates work in the exact same way. We've got a chart going back to 1790. No one can accuse me of not going far enough back in time with my charts. We go all the way to today's date on the left. We go from 0% up to 15%. This shows these interest rate cycles as they happen and how long it takes for them to usually play out. So starting in 1790, we see that interest rates were about 5%. By 1798, they got up to 10%. They go back down, 1824, right around 5 again. They go back up 1842 to, let's call it 12%. So this full cycle from peak to peak took about 44 years. That's key. These red lines are very important. So the next cycle went from 1842 to 1920. And again, I'm measuring a cycle, or we're defining a cycle from peak to peak, not peak to trough. So then the next one, 61 years. So if you look at this chart, it shows an average of the past super cycles we've had. And it averages out to about 70 years. So the last peak, as most of you know, was 1981. So what this would imply is the next peak in interest rates will occur right around 2050. So that's another 27 years of interest rates going up. So let's think about this for a moment. We all know that the supply side of residential real estate is pretty much at all-time lows. But no one ever talks about the demand side of the equation. You see, over the last year, even nominal prices in some areas have come down. Some areas gone up and some areas flat. Now, when you adjust for inflation, a lot more of those prices have come down in several cities and states around the US and globally. More on that in step number 3. But the bottom line is, even if nominal prices, let's say in the United States, have been flat over the last 12 months, the demand is at an all-time low. Because if supply is at an all-time low and prices aren't going up, that tells you that demand is at an all-time low. So this puts us in a very precarious position, that if anything were to increase supply, it could have a massive impact on prices of those homes that are for sale. And you guys know from watching my videos that the price of a house, or the value of the housing market, is set at the margin. So whatever those 500,000 houses that are for sale right now, let's say in the United States, trade for, that's going to dictate the value, the price of the other 140 million houses. In other words, even if you're not in the real estate market, but you own a home, that could dramatically impact your home equity. And I'd like to remind everyone that right about now, one of the main reasons demand is so low is because mortgage rates on a 30-year fixed rate mortgage right around 8%. That's extremely high relative to what we've seen over the past decade. Now, historically, that's not high at all. But this puts the average Joe into a very difficult position where they just simply cannot afford the monthly payments for the house that they would like to buy. In fact, a lot of average Joes, it puts them into a position where they can't afford to buy any house because those interest rates, in other words, those monthly payments, are just too high, especially when you combine that with the higher home prices that we've seen since 2019. But wait a minute here. Let's think this through. If this long-term supercycle holds true and interest rates, mortgage rates right now in 2023 are, let's say, at 8%, where are mortgage rates going to be over the next couple decades if interest rates continue to go up to 2050. In other words, for the next 27 years. We could see mortgage rates head straight back to where they were in the late 70s or early 80s at 18, 19, maybe even 20%. So you got to ask yourself, what would that do to the overall price of the housing stock in the United States? What would that do to your home equity? Step number 2. So it's not just mortgage rates potentially going up for the next 27 years that could dramatically impact real estate prices. It's also all of these subsidies that nobody has been really talking about. So let's go right over to an article from wolfstreet.com, and you'll see exactly what I'm referring to. Title: Mortgage Rate Buydowns by Home Builders are now all the rage to prop up sales, lowering effective house price for the buyer, they say in a big way, but don't get picked up in the house price data. This is crucial that we get our head around this. So going down through the article, they say, so the pricing data that we have from the Census Bureau about sales, and I would argue the Case-Shiller or any of these statistics that you see, do not include the cost of mortgage rate buydowns. And then they go on to show this chart of the median price of new single-family homes sold since 2004. And you can see in 2022, it spikes up to, let's just say, $500,000. But recently, it's gone down to roughly $425,000. So one of the points they make in this article is just think how much further prices would have gone down if they would have reported the numbers accurately and subtracted those incentives, those home builder mortgage rate buydowns from the actual sale price. So I know a lot of you right about now are saying, okay, George, well, won't they just continue these subsidies indefinitely into the future, and won't that just continue to prop up prices artificially? But unfortunately, these subsidies are likely coming to an end very, very soon. For more details, let's cut to a clip from the Forward Guidance podcast, one of my favorites, and this is Jack Farley and Warren Pies talking about these mortgage rate buydowns.
If you think about single-family home market, public builders who their stock's been on fire. So you think about Lennar, Pulte, D.R. Horton. Those they make 50. They produce 50% of single-family homes in the United States. Publicly traded builders. They finance those houses themselves there, and so they're able to buy down the rates. That's been a big factor. So they're able to. It's ultimately just an incentive. And you can see this in builder margins, and this is why we think that as mortgage rates hit 8%. That's where the margin that's available for these builders to buy down those rates, it gets impacted. If you listen to the calls, the builders say, okay, this is where we're going to start backing down on activity. A lot of things happen around this 8% mortgage rate.
Sorry, Warren. So people say 8% is going to slow down the housing market, or 7% mortgage rate is going to slow down the housing market. To the extent that it hasn't, it's because home builders are eating the loss. They're saying, "Oh, we'll give you a 4% mortgage, or we'll take the hit of the spread between the 8% and the 4%," as well as the fact that the existing home market the volumes are down because everyone who has a low mortgage is going to stay in their homes. But the buydowns are unsustainable.
They're unsustainable. So it's ultimately just there is no difference in a mortgage buy down, economically speaking, to a builder when you really just strip it away from just discounting the price of the house. It's just an incentive, and it's how you structure that incentive and gets people into houses. And they've done other things. They've pulled other levers like making houses smaller and a little cheaper, and they can do that up to a certain point. But I do believe that from our analysis that 8% is about where you run out of runway for these big publicly traded builders.
Now let's go over a visual on the whiteboard so we can all understand how these subsidies coming to an end will likely impact real estate prices moving forward. So we start off with everyone's favorite, Moody the Millennial, in their blue hair. So right now, Moody can afford $2,000 a month as far as their mortgage payment. That's what they can afford with their main job and their 2 or 3 side hustles that, of course, they have. So Moody looks at this house and they say, wow, that is fantastic. That is the perfect house for me. But unfortunately, right now, this house is $400,000. It's a brand new house. And interest rates are 8%. So let's just assume for a moment, this isn't exact math. I just made these numbers up just for the sake of example. But let's just assume for a moment that the mortgage payment on a $400,000 house at 8% would be $2,500 a month. Well, Moody has a problem. You see, that's $500 more than I was got to watch the pronouns there, than they can afford. So Home Corp XYZ, the home builder, comes in and says, Moody, no problem. We're going to go ahead and pay that interest for you that will bring your overall rate from 8%, let's say, down to 4%. And this is going to cost Home Corp $50,000 to prepay that interest to get their rate down to a level that monthly payment is within their price range. So you say, well, how on earth can Home Corp XYZ home builder do this? Well, let's say the cost of their house to build it is $300,000 all in, and they drop that price basically from $400 down to $350 because they're having to absorb this $50,000 of prepaid interest. They're still making a profit, let's say, of $50,000. But to Warren and Jack's point, if interest rates, mortgage rates, continue to go up, 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 this is fine at 5% as far as these financial shenanigans, but at 8% plus, all of a sudden, they're not making any more profit. So if we have mortgage rates stay at this level or continue to go higher, this subsidy comes to an end. But if we look at this through the lens of the Wolf Street article, we see that there are other knock-on effects. So what the home builder is basically doing is they're just dropping the price by prepaying this interest. So the house would normally sell for $350,000. That would be the clearing price at an 8% interest rate to get that monthly payment that the buyer, in this case Moody being the proxy for buyers, can actually afford. So if this house would have sold for $350,000 instead of $400, this would have dropped the values for the other homes in the neighborhood because their values, even though they haven't traded hands, let's say over the last 5 or 10 years or whatever, are priced based on the comps. So if the comps are $50,000 lower, that's going to bring down the overall prices. In other words, the overall home equity that those homeowners have within that neighborhood. And if that home equity is artificially inflated right now, that means that purchasing power is artificially inflated, so is aggregate demand. So if we can safely assume these mortgage rate buydowns have artificially increased the prices of the new homes that have sold recently, we can also assume that if those mortgage rate buydowns no longer exist, that the prices will revert back down to their natural level based on the purchasing power of the buyers. And this, of course, will impact comps, it'll impact home equity, and like we said earlier, it'll impact overall purchasing power, aggregate demand in the real economy. Oh, but wait, there is more. Now we need to talk about something that could really impact prices moving forward. And this is not just about to happen, it's happening right now as we speak. Step number 3. We talked about how the demand side of the equation could change moving into 2024. But now let's talk about the supply side. This is from the Miami Herald via yahoo.com. Thinking about going bare. Just wait for the rest of the title. What to know before you cancel your property insurance. So we can see going down this article that right now in Florida, as an example, the average cost to insure a home for the year is $6,000. This is 42% higher than it was in 2022. The $6,000 per year amount is really at the bottom of prices being quoted, according to the experts in this article from the Miami Herald. One of those experts says, I've never seen something like this in the market, not even during 1992 when a hurricane destroyed parts of South Miami-Dade, and this set off record high damage. So not even during that time did property insurance rates go up to the same degree that we've seen over the past 12 months. So it's not just property insurance that's going up dramatically. It's also property taxes. It's also the cost to maintain your home. So the talking heads in the mainstream media always get fixated on the fact that, well, the mortgage costs aren't going up for those people who locked in a 30-year fixed rate mortgage, let's say at 3%, and therefore they're never going to be forced to sell. Oh, really? Well, that assumes something that's completely inaccurate. What I mean by that assumes that your only cost of housing is your mortgage payment. Absolutely not. It's all of these other things. So let's say that you can afford for your overall housing cost right now $3,000, but yet your housing cost goes up to $4,000, not because your mortgage payment goes up, but because your property taxes and your property insurance increases along with everything else. So at the end of the day, whether it's one thing going up or the other, the net result is still the same. And that's that you can't afford the house, therefore you have to sell. So where this leaves us is if incomes don't increase at the same level of all these other prices, including the price of money, which would be interest rates, this is going to lower demand and it's going to increase supply, which would obviously put significant downward pressure on prices. But let's not forget that the Federal Reserve right now is fighting inflation. They're trying to get the CPI down below their 2% target. How are they doing this? It's not just increasing interest rates. What are they trying to achieve by those interest rate hikes? They're trying to increase the unemployment rate. In other words, they want fewer people. They want fewer Americans with jobs. Well, fewer Americans have jobs. That means fewer Americans can afford to buy a house. Fewer Americans can afford to maintain a house. That brings demand down even further and increases supply even more.